In 2006, the world's largest banks were moving billions of dollars every second, but the actual communication driving those trades was casual. Traders and rate submitters were firing off quick, typo-ridden instant messages that looked more like teenagers chatting after school. Take a specific request from December 14th. A Barclays trader in New York bluntly messaged a colleague in London, explaining they were very long on 3-month cash and needed the rate set as low as possible. His colleague's response was immediate. "You heard the man." This chart shows the result. On December 18th, Barclays' official submission takes a sharp V-shaped dive. After receiving that chat, the submitter actually sent himself a calendar reminder saying USD 3-month down, and then forced the bank's reported rate to plummet. This vertical gap between the actual market rate and Barclays' submission represents the profit margin. By nudging the average down by just a few basis points, the trader increased the payout on his derivatives, complex financial bets tied to these interest rates. Every fraction of a percent moved off the average translated into millions in profit. These gains were extracted directly from global borrowers who unknowingly paid skewed interest rates on their personal and business loans. This wasn't a niche problem. LIBOR anchored the interest rates on hundreds of trillions of dollars in global contracts. If you had an adjustable rate mortgage or a student loan, your monthly payment was likely tied to this single benchmark. But the system had a mechanical flaw. The rate wasn't calculated using hard data from actual money moving between banks. Instead, the entire benchmark relied on a daily guess. It was an honor system. Every morning, a panel of major banks was simply asked to estimate the rate at which they could borrow money. They submitted their numbers without having to provide any transaction records to prove the figures were real. This lack of oversight encouraged narrow framing. Inside the banks, employees viewed these rate submissions as a daily administrative task rather than a global economic anchor, ignoring the consequences of their skewed numbers as long as the work got done. The most critical pillar of global finance was completely unguarded. It had effectively turned from a public benchmark into a private casino, where mid-level bankers could tweak the odds to suit their own trading desks. The atmosphere shifted when the 2008 financial crisis hit. The confidence of the trading floor disappeared, replaced by widespread panic as the global banking system began to lock up. Suddenly, everyone was watching LIBOR. Journalists and investors began using a bank's daily rate submission as a thermometer for bankruptcy. If a bank reported a high borrowing rate, it suggested they were in trouble and couldn't find cash. This created a high-stakes dilemma. If Barclays submitted an honest, high rate reflecting the actual market stress, the press would assume the bank was collapsing. That could trigger a stock crash or even a run on the bank. The corruption climbed the corporate ladder. Senior executives began pressuring submitters to report artificially low rates as a public relations strategy, desperate to project an illusion of stability to the markets. This was now a coordinated institutional effort. Barclays was reporting fictional numbers to protect its own stock price, using the benchmark as a shield against the mounting market panic. We know this because the phone lines were recorded. In April 2008, a senior Barclays rate submitter called a manager to voice his distress. He was seeing the real market data, and it didn't match the numbers he was being told to post. The submitter was blunt about the fabrication. He told his manager, "I would be paying 2.98 today, and I'm going to be setting my LIBOR at 2.74, and I'm as guilty as hell." The manager didn't blink. He told the submitter to stay around the top of the pack, but to make sure they didn't stick out. The priority was no longer accuracy. It was blending in with the other banks who were also reporting fake numbers. LIBOR had detached from reality. The objective rate anchoring the world's wealth was now just a fictional PR strategy managed by terrified executives. The bubble finally burst when regulators like the DOJ and the FSA uncovered the evidence. They waded through years of chat logs and audio recordings that detailed exactly how the rates were being faked. The fallout was massive. Regulators levied record-breaking multi-billion-dollar fines against Barclays, UBS, and other panel banks. The scale of the deception was finally exposed to the public. The regulatory verdict was that LIBOR was beyond saving. Because the benchmark relied on human estimates rather than verifiable transactions, it could never be made truly secure against manipulation. Finding the banks wasn't enough. The global financial system's trust in the benchmark itself was destroyed, and the authorities realized they had to build something entirely new. This led to a global pivot. By June 2023, the world began abandoning LIBOR in favor of SOFR, the Secured Overnight Financing Rate. The difference is mechanical. SOFR isn't based on an estimate. It is calculated using trillions of dollars in actual, verifiable overnight transactions. It is a reflection of money that has already moved. You cannot ask a colleague to lower a transaction that has already cleared. By anchoring the rate to concrete historical data, the new system removes the human vulnerability that the LIBOR traders exploited. The scandal forced the global economy to learn a brutal lesson. Markets cannot function on the unverified honor of a few individuals. They demand the absolute transparency of hard data.